Go ahead. Try to buy silver at $80. I'll wait. You can't, can you? The screen says the price crashed. Your brokerage account shows $80 per ounce. The headlines are screaming about the precious metals collapse. But the dealers? The dealers say they're empty. For the first time in their company's history, SD Bullion, one of the largest precious metals dealers in the United States, considered shutting down their entire trading platform. Not because of a website crash, not because of regulatory issues, because they literally cannot find metal to sell you. Let me read you their exact statement. This is the first occasion in our company's history where our team contemplated suspending the trading platform for physical silver due to our inability to acquire additional ounces from suppliers. Read that again. A major U.S. bullion dealer has never been this close to shutting down silver sales entirely. Not in 2020 during the COVID panic. Not during the Wall Street bet squeeze. Not during any previous shortage. Now, today, while the price is supposedly crashing to $80, here's what's happening right now as I speak. APMEX, JM Bullion, SD Bullion, the three largest online dealers in America, are quoting delivery times of 3 to 4 weeks on popular items. And that's if you're lucky. Some dealers are quoting 8 to 12 weeks. That's 3 full months. Let me put that in perspective. 3 months ago, you could order a silver eagle and have it at your door in 5 business days. Today, you place an order and they're telling you maybe March, maybe April. We'll let you know. The 2026 American Silver Eagles, the coins that the U.S. Mint normally ships to dealers by January 10th, are now delayed to early February at earliest. We're on February 3rd. They still don't have them. These aren't specialty coins. These aren't collectibles. These were the standard bullion products that move millions of units every year. But here's the truly terrifying part. It's not just America. A Facebook post from a global trader last week. Whole world can't source physical silver now. No delivery date from all traders around the world. The Royal Mint in the United Kingdom is warning of delivery delays on Silver Britannias. Singapore dealers are warning of massive shortages and the risk of a complete stockout for the first time in 7 years. Reports from Australia say entire cities are running low, with pawn shops and bullion stores having little to no silver available. There's a video circulating called the 2026 Silver Rationing. Why your local coin shop just went dark. Rationing. We're not talking about premiums anymore. We're not talking about delivery delays. We're talking about rationing of a physical commodity while the paper price says it crashed 30%. So yes, the chart says we're down to $80 from the $121 highs. Yes, that's a brutal 33% correction. And yes, I'm going to validate that crash because it's real on paper. But that paper price is a lie. I am holding the real price list in my hand, and it tells a terrifying story. Because while your screen shows $80, the dealers who actually have metal, if you can find them, are charging $90, $100, $110. In some markets, $143 per ounce. That's not a premium. That's a different market entirely. By the end of this video, you will understand why the lower the paper price goes, the harder it becomes to get any metal at all. You will understand why this crash wasn't about fundamentals or fear. You will understand why the vaults are empty, the dealers are panicking, and the biggest default in commodity market history is unfolding in slow motion 24 days from now. Let me show you the receipts. February 2nd, 2026, 6:48 a.m. Eastern Time. I want you to remember that timestamp because it's the moment the entire fraud was exposed in broad daylight. At 6:48 a.m. Eastern, the Shanghai Gold Exchange was trading physical silver at $99.17 per ounce. At that exact same timestamp, COMEX, the New York Futures Exchange, was trading paper silver at $83.81 per ounce. The spread? 18.3%. Let me ask you a question. If you could sell silver in Shanghai for $99 or sell it in New York for $83, which one would you choose? You'd sell in Shanghai, obviously. Every single time. You'd ship every ounce you could find to Shanghai and collect that $15 premium. Unless, and this is the critical point, unless the New York market is broken. Unless there's no actual metal backing those paper contracts. Unless Shanghai is paying a premium because they're the only market where physical delivery still happens. That's not speculation. That's exactly what's happening. Fast forward 8 hours. 2 p.m. China local time. Same day, February 2nd. The Shanghai Gold Exchange is now bidding $89.15 per ounce. COMEX paper price has collapsed to $74. The premium just widened to 20.5%. Think about that. The paper price dropped $10. The physical price dropped $10. But the spread between them grew. The market isn't converging. It's diverging. And here's where it gets absolutely nuclear. Researcher Fei Yin went boots on the ground in Shenzhen on February 2nd. He walked into the Shuaibei market, China's major physical silver trading hub, and surveyed 10 different dealers. Real shops, real inventory, or lack thereof. Here's what he found. The average dealer selling price for physical silver in 1 kilogram bars, $110 per ounce. COMEX paper price at that exact moment, $74 per ounce. That's a 48.6% premium. Let that sink in. The paper market says silver is $74. The physical market in China is charging $110. That's not a spread. That's a parallel universe. But wait, it gets better. Or worse, depending on where you're sitting. The price range among the 10 dealers Fei surveyed. Lowest price $106 per ounce. Highest price $116 per ounce. And 2 dealers, 2 out of 10, refused to sell at all. Why? Because they purchased their inventory at $143 per ounce during the peak, and they're not willing to sell at a loss. They're just sitting on it, waiting, because they know. Now let's talk about the buyback prices. What happens if you walk into one of these dealers and say, I want to sell you my silver? One dealer, not buying, inventory full. Another dealer, I'll pay you spot price, $89.15. Third dealer, I'll pay you $89.60. Do you see what just happened? Even the dealers who will buy from you, even in China where the premium is insane, are paying you $89 to $90 per ounce. That's $15 to $16 more than COMEX paper. The physical market in China has completely decoupled from the Western paper exchanges. But maybe you're thinking, okay, that's China. They're always paying premiums. What about the rest of the world? Here's your answer. Chinese companies are calling Canadian silver producers and offering them $8 per ounce above spot price for direct delivery. Not traders, not speculators, mining companies, the people who dig it out of the ground. Why would Chinese buyers pay $8 over spot to a Canadian miner when they could just buy it on COMEX for spot price? Because COMEX doesn't have it. Because London doesn't have it. Because the paper markets can't deliver what they've sold. And here's the geopolitical angle nobody's talking about. Shanghai visible silver inventories, the stockpiles that China actually reports, are at their lowest levels since 2016. Even China, which controls 60% to 70% of global refined silver exports, is running low. And what did China do on January 1st, 2026? They implemented a total export ban on refined 999 silver. Not a tariff, not a quota, a complete ban. Every ounce of silver that China produces, and they're one of the largest producers in the world, stays in China. Forever. Western manufacturers, Indian importers, European traders, they're all bidding on a pool of available supply that just shrank by 60%. And that's why Shanghai is paying an 18% to 48% premium. Because there is no arbitrage left. Because you can't just ship metal from London to Shanghai anymore. Because the metal isn't there. One analysis from late January noted, a price gap this large and persistent is extremely rare in recent years and clearly signals acute tension in Asia's physical market. By early February, that rare gap has doubled. The East is draining the West, and the West is playing pretend with paper contracts, hoping nobody notices that the vaults are empty. But I noticed, and now you know. Stop. I need you to do something right now, because the data I'm showing you is real, but I want to know what's happening in your world. Right now, today, this is the boots on the ground report. I want you to call your local coin shop. Right now, pause this video if you have to, or check your online dealer. Apnex, JM Bullion, SD Bullion, Monument Metals, any of them. Are they sold out? Are the premiums insane? Can you actually buy silver at $80? Or are they quoting you $95? $100? $105? Here's what I want you to do. Go to the comments section right now and type one of two things. Type sold out if you can't find metal, if your dealer is out of stock, if they're quoting you 8-week delivery times, if the premiums are 20%, 30%, 50% above spot. Or type available if your local shop still has inventory at reasonable premiums and you can walk out the door with metal today. I want to build a real-time map of this shortage. I want to know if this is regional or if this is global. I want to know if what I'm seeing in the data matches what you're seeing on the ground. Cast your vote right now. Sold out or available. Do it. Because here's what I think is happening. I think the dealers know. I think they're watching the COMEX inventory drain. I think they're watching the Shanghai premium widen. I think they're seeing the 8-week delivery times from their suppliers. And I think they're holding back inventory because they know what's coming. On February 27th, 24 days from today, the March delivery window opens on COMEX. And when that window opens, we're going to find out if the emperor has any clothes. But we'll get to that in a minute. First, let me show you why the vaults are already empty. Let's talk about registered inventory. This is the physical silver sitting in COMEX-approved vaults that's available for delivery against futures contracts. This is the actual metal backing the paper trading. In 2022, COMEX registered inventory peaked at 140 million ounces. In 2024, it dropped to 85 million ounces. Right now, in January 2026, it's sitting at 60 to 65 million ounces. That's a 57% decline from peak. That's 75 million ounces that vanished. But here's where it gets truly alarming. Between early and mid-January 2026, over the span of just 7 days, 33.45 million ounces were physically withdrawn from COMEX for delivery. That's 26% of registered inventory disappearing in 1 week. Let me put that in perspective. If your bank lost 26% of its deposits in 7 days, would you call that a normal withdrawal pattern? Or would you call that a bank run? This is a bank run on physical silver, and it's happening in slow motion while the paper price crashes. But wait, it gets worse. Because a significant portion of what COMEX reports as registered inventory is either non-eligible or already encumbered. It's already been sold. It's already been promised to someone else. It's metal that exists on paper but isn't actually available for delivery. So that's 60 to 65 million ounces. The real number might be 40 million, maybe 30 million. We don't know because the reporting is intentionally opaque. Now let's talk about the March delivery window. This is where the math becomes catastrophic. Open interest for March 2026 silver contracts, 128,000 contracts. Each contract represents 5,000 ounces. Total potential delivery demand, 640 million ounces. Registered inventory available, 74 million ounces. Do the math. That's 528 paper ounces for every 1 physical ounce available. If even a fraction of contract holders stand for delivery, COMEX cannot fulfill. It's mathematically impossible. And here's the really terrifying part. Historically, 97% of futures contracts roll forward or cash settle. Only 3% demand physical delivery. That's how the system works. That's how it's always worked. The exchanges rely on almost everyone taking cash instead of metal. But in January 2026, something changed. The number of contracts standing for delivery, 21,000 contracts. That's 105 million ounces of delivery demand. The registered inventory, 74 million ounces. There's already a 31 million ounce shortfall. Before first notice day, before the March window even opens. First notice day is February 27th, 2026. That's 24 days from now. That's the deadline when delivery intentions are finalized for March contracts. One analysis warns, if 25,000 or more contracts stand for delivery, COMEX's registered inventory will be insufficient. The exchange will face a delivery crisis. We're already at 21,000. We're 4,000 contracts away from a default, and we still have 24 days of trading left. But maybe you're thinking, they'll just raise cash settlement prices. They'll force people to take dollars instead of metal. Okay, let's say they do that. Let's say they offer you $100 per ounce in cash to go away quietly. Except Shanghai is paying $110 for physical. China is offering Canadian miners $8 over spot. The premium is widening, not narrowing. So you take your $100 cash settlement from COMEX, and then what? You try to buy physical silver with it? Where? From which dealer? At what premium? The system is breaking, and the people running it know it's breaking. That's why they crashed the price. Let me show you one more piece of evidence that proves the plumbing is broken. Exchange for Physical, or EFP, is the mechanism that allows COMEX traders to swap paper contracts for physical metal in London. This is what kept the system functional for years. You couldn't get delivery in New York? Fine. Take delivery in London. Problem solved. Except the EFP volume has collapsed. In March 2020, EFP volume peaked at 362,049 contracts. In March 2025, it dropped to 40,708 contracts. That's an 89% decline. In June 2019, EFP volume was 202,656 contracts. In June 2025, it collapsed to 31,240 contracts. That's an 85% decline. The bridge between paper and physical markets is broken. The arbitrage mechanism that used to keep prices aligned across exchanges doesn't work anymore. And that's why the spread between COMEX spot and front-month futures widened from $2 to $5 in 2017 to $30 to $50 in late 2024. That's why dealers in London are reporting multi-week delivery delays. The entire infrastructure connecting paper promises to physical metal is failing. But there's one more data point I need to show you. This is the smoking gun that proves physical scarcity even as the paper price crashes. Silver lease rates. This is the cost of borrowing physical silver. Historically, lease rates hovered near zero because supply was abundant. Why would you pay 1% or 2% to borrow silver when there's plenty of it sitting in vaults? But in mid-2025, lease rates went over 6%. In September 2025, they were above 5%. On October 9, 2025, they hit an all-time record of 34.9%. Right now, as of early 2026, lease rates are sitting around 8%. An 8% lease rate means the market is short of silver to a clearly abnormal degree. It means the people who actually hold physical metal are charging 8% annualized premiums just to lend it out for a month. You don't see 8% lease rates in a surplus. You see 8% lease rates in a famine. And that famine is getting worse. Because the silver market has been in continuous deficit since 2021, 5 straight years of structural deficits. The cumulative deficit from 2021 to 2025, 820 million ounces drawn from above-ground inventories. The expected deficit for 2026, another 200 million ounces. Where is that metal coming from? It's coming from the vaults. It's coming from COMEX registered inventory that's down 57% from peak. It's coming from exchange stockpiles that just lost 26% in 7 days. And here's why it can't be replaced: solar panels. Silver now accounts for 29% of solar panel production costs in 2026. That's up from 14% in 2024. Silver is now a critical factor in manufacturing expenses for the energy transition, and that demand cannot be substituted. There is no replacement for silver in photovoltaic cells that matches its efficiency. So we have structural deficits, draining vaults, exploding lease rates, and irreplaceable industrial demand. And the paper price just crashed to $80 to convince you none of this matters. Let me tell you what really happened on January 30th, 2026. On Friday, January 30th, Kevin Warsh was nominated to succeed Jerome Powell as Federal Reserve Chair. The market calls him a hard money hawk, someone expected to prioritize aggressive balance sheet reduction and higher real yields. And precious metals, which don't pay interest, sold off violently. Gold crashed 11% in a single session on February 2nd, from all-time highs of $5,600 down to $5,000. Silver crashed 30%, from $122 per ounce down to $80 in 2 days. The move was described as reminiscent of the 1980 Hunt Brothers collapse. Massive, historic, brutal, and to stem the bleeding, the CME Group hiked margin requirements for gold and silver futures by 8% to 16.5%. But that didn't stop the bleeding. It made it worse, because the margin hikes forced a secondary wave of liquidations from leveraged retail traders and hedge funds who could no longer meet collateral demands. On Monday morning, February 2nd, refineries and major bullion dealers in New York's Diamond District halted all buying operations. They couldn't provide accurate pricing amid 25% intraday swings. A veteran dealer said, "It's absolute pandemonium. We have lines of people trying to sell at prices from 3 days ago, and we have no cash left to buy." And then he said this, and I want you to remember this quote. The spread between the paper price and what you can actually get for a physical coin has widened to levels we haven't seen in decades. That's your smoking gun. The crash wasn't about fundamentals. It wasn't about Fed policy or hard money hawks or balance sheet reduction. The crash was a leveraged liquidation event in the paper market that exposed the physical shortage underneath. Because while the paper price collapsed from $122 to $80, while futures traders were getting margin called and forced to sell, the physical market broke. SD Bullion considered shutting down their platform. Dealers started quoting 8 to 12-week delivery times. Shanghai premiums widened from 15% to 48%. Chinese buyers started calling Canadian miners, offering $8 over spot. COMEX lost 33 million ounces of registered inventory in 7 days. The paper price said silver crashed. The physical market said there's none left. And now we're 24 days away from first notice day with a 31 million ounce shortfall that already exists before the March delivery window even opens. So let me summarize the trap for you. The trap isn't that silver crashed to $80. The trap is that the crash convinced retail investors to stay away while the vaults are being drained by institutional buyers who know what's coming. The trap is that the paper price, $1.80 per ounce, is a lie designed to discourage you from buying. The physical price, $1.90, $100, $110, $143, depending on where and what you're buying. That's the reality. And the difference between those two prices is the spread between the illusion and the truth. You want to buy silver at $80? Go ahead. Try. Call Apnex. Call JM Bullion. Call SD Bullion. See what they quote you for delivery. See how long they tell you to wait. Or better yet, check the comments section. See how many people typed sold out. See how many people typed available. Because if you commented sold out, you already know what's coming. You already know that the cheaper the paper price gets, the harder it is to get physical metal. And if you're still sitting on the fence, if you're waiting for the price to drop more before you buy, let me ask you this. What good is a $70 paper price if no dealer has inventory? What good is a $60 COMEX quote if the delivery time is 4 months? What good is a cheap price if the metal doesn't exist? The vaults are bleeding. The dealers are panicking. The physical market in China is paying 48% premiums. COMEX registered inventory is down 57% from peak and lost 26% in 7 days. First notice day is 24 days away with a 31 million ounce shortfall that already exists. This isn't a correction. This is a default unfolding in slow motion. And the crash to $80 wasn't designed to give you a buying opportunity. It was designed to hide the crisis long enough for the smart money to drain every last ounce out of the vaults before the system breaks. Don't let the $80 price tag fool you. That's the price for paper. If you want the real thing, get in line. If you commented sold out, you know what's coming. Subscribe to this channel to watch the COMEX break. February 27th, 2026. First notice day. 24 days from now. The vaults are empty. The dealers are panicking. The physical market is broken. And the paper market is about to find out what happens when 528 paper ounces compete for every one physical ounce. This John AG. We don't trade the price. We trade the corruption. Now you know.